Let's take a look at defined retirement plans. Retirement plans defer income until after employment ends. The first U.S. pension plan was established in 1759 for Presbyterian ministry families, and American Express introduced a formal plan in 1875. Pension growth accelerated after the 1921 Revenue Act, which gave favorable tax treatment, and World War II wage controls further encouraged benefit-based compensation. Today, qualified retirement plans continue to offer tax incentives to both employers and employees, with taxes paid only on distribution. Participation in retirement plans has declined slightly over time, with a notable shift from defined benefit to defined contribution plans. Qualified plans also allow tax-free investment growth and deferred taxation on retirement benefits until they're distributed. Qualified plans have 13 key characteristics that set the minimum requirements for employer and employee tax benefits. Participation rules generally allow employees to join after reaching age 21 and completing 1 year of service, or 1,000 hours. Coverage requirements prevent favoring highly compensated employees, using either the ratio percentage test or average benefit test to ensure fairness. Defined benefit plans must also cover at least 50% of employees or 40% of the workforce. Vesting rules protect employees' rights to their own contributions and over time to employer contribution. Non-discrimination rules prohibit preferential treatment for highly compensated employees, satisfied through safe harbors or testing. Top-heavy provisions require minimum benefits and vesting if key employees hold over 60% of total plan benefits. Minimum funding standards ensure employers contribute enough to meet promised benefits, and plans may integrate with Social Security under certain limits. Distributions can be triggered by separation from service, the 10th anniversary of participation, or reaching normal retirement age, and may be paid as lump sums, annuities, or periodic payments. Additional rules cover spousal protection, QDROs in divorce, and strict termination procedures for defined benefit plans. Defined benefit plans promise a fixed retirement benefit. This is usually a percentage of pre-retirement paid multiplied by years of service, paid as a lifetime annuity. Employer contributions vary annually based on funding needs and life expectancy projections, which have increased in recent years. Two main benefit formulas exist: flat benefit formulas, which do not factor in years of service, and unit benefit formulas, which do. Flat benefit formulas may provide a set dollar amount per employee or percentage of final average pay, often based on at least 3 or 4 years of service. Unit benefit formulas link benefits to years of service, using either a fixed dollar or percentage per year worked. Plans must meet uniformity standards and safe harbor rules to prevent inconsistent or discriminatory benefit allocation. Accumulated benefit obligation measures the present value of earned benefits calculated by actuaries considering investment returns, service length, and life expectancy. The IRS enforces anti-backloading rules to ensure benefits accrue evenly over time. ERISA requires annual contributions, actuarial reporting, and compliance review. These rules ensure defined benefits plans remain fair, fully funded, and compliant with federal law. Defined contribution plans have annual employer and employee contributions to individual accounts based on a set formula. Employers usually contribute a percentage of each participant's pay, investing funds in vehicles such as company stock, diversified funds, or government bonds. These plans do not guarantee specific benefit amounts. Benefits depend on contributions, investment performance, and forfeitures from non vested accounts. Common types include profit sharing plans, stock bonus plans, and employee stock ownership plans. Contributions can come from four sources: employer contributions, employee contributions, forfeitures from non vested accounts, and investment returns or losses. ERISA requires a named fiduciary to manage investments, who may delegate to investment managers that diversify assets to balance risk and return. Plans must meet safe harbor conditions such as a uniform allocation formula to comply with non discrimination rules. Accrued benefits equal the amount balance. The employers cannot reduce contributions based on age or set maximum age limits. Minimum funding standards are met when contributions match the plan's specified amounts, and annual additions cap the total yearly contributions from all sources. Employer deductible contributions vary depending on type of defined contribution plan. A variety of defined contribution plans are available. 401k plans allow employees to defer part of their pay into a qualified plan with tax benefits, including pre tax contributions, employer deductions, and tax deferred investment growth. Roth 401k plans, introduced in 2006, use after tax contributions but allow tax free withdrawals at retirement, help employees manage uncertain future tax rates. Profit sharing plans distribute company funds to employees based on formulas tied to profits, sales, or other measures with capped employer deductions. Common profit sharing formulas include fixed percentage of profits, graduated percentages, and profitability thresholds with minimums and maximums. Stock bonus plans are similar to profit sharing plans but provide company stock instead of cash, giving participants shareholder voting rights. ESOPs are stock bonus plans that typically use borrowed funds to purchase company stock and distribute it to employees. Simple plans serve small employers, 100 or fewer employees, without other retirement plans, offering a straightforward match based saving option. 403B plans provide tax deferred annuities for employees of public schools, tax exempt organizations, and certain hospitals, while 457 plans offer non qualified retirement savings for government employees. Each plan type offers unique features, tax benefits, and eligibility rules. Hybrid plans combine features of traditional defined benefit and defined contribution plans. Many employers have moved from traditional defined benefit plans to hybrids to attract younger, more mobile workers and reduce costs. Cash balance and pension equity plans calculate benefits based on a hypothetical account balance or equity formula, often costing employers less and providing more predictable contributions. Benefits in these plans are usually offered as a lump sum, which can be taken directly or converted to an annuity, increasing portability for employees who change jobs. Like defined contribution plans, companies set up individual accounts and make credit contributions using fixed percentages or formulas based on age, service, or earnings. Target benefit plans are used to defined benefit style formulas to set target benefits, but the actual retirement amount depends on investment performance. Money purchase plans are defined contribution plans with annual employer contributions, but they carry the mandatory funding requirements of defined benefit plans. Age weighted profit sharing plans allocate more contributions to older employees to help them reach a similar projected retirement benefit as younger workers. Overall, hybrid plans aim to balance predictable employer costs with portable performance based benefits for employees.